Have you ever wondered how JEPI or VOO compare? Well, today we'll be diving into that very question. Let's start off by understanding these two investment options. JEPI, or the JPMorgan Equity Premium Income ETF, is a unique player in the market. This fund aims to provide a high level of current income with the potential for long-term capital appreciation. The fund primarily invests in large-cap US stocks and writes call options on those stocks to generate income. On the other hand, we have VOO, the Vanguard S&P 500 ETF. This is a passively managed fund that aims to track the performance of the S&P 500 index. It's a broad, diversified fund that gives you exposure to 500 of the largest US companies. Two different funds, each with its own strategy and potential benefits. So which is the better investment? Let's dive in and compare these two investment options. First, let's look at the performance summary of both JEPI and VOO. Imagine you invested $10,000 in each of these funds. Fast forward, and your investment in JEPI would have grown to $13,659, while VOO would have pushed your investment to a handsome $15,343. But let's dive deeper. The annualized return, or compound annual growth rate, for JEPI stands at 9.32%, while VOO boasts a higher 13.01%. However, higher returns often come with higher risks, and this is no exception. The standard deviation, a measure of volatility, is 11.09% for JEPI, significantly lower than VOO's 16.87%. Now, let's talk about the best and worst years for these funds. JEPI's best year saw a return of 21.5%, but its worst year dipped to a negative 3.52%. On the other hand, VOO's best year soared to 28.78%, but its worst year plummeted to a staggering negative 18.19%. Remember to subscribe and comment on what time you would like me to look into next. Anyway, back to looking at the maximum drawdown, which measures the largest single drop from peak to bottom in the value of a portfolio, is negative 12.99% for JEPI, while VOO experienced a more significant dip at negative 23.91%. The Sharpe ratio, a measure of risk-adjusted return, is 0.62 for JEPI and slightly higher for VOO at 0.66. The Sortino ratio, which also measures risk-adjusted return but puts more emphasis on downside risk, is 1.02 for JEPI and 1.01 for VOO. While VOO shows higher returns, it also comes with greater volatility, but there's more to consider. Now, let's take a look at the expense ratios and dividend yields of JEPI and VOO. In the world of investing, expense ratios and dividend yields are two critical factors to consider. These metrics can significantly impact your investment returns over time. So let's dive right in and explore them for our two contenders, JEPI and VOO. First up, expense ratios. This is a measure of what it costs an investment company to operate a mutual fund or an ETF. An expense ratio is determined through an annual calculation, where fund operating expenses are divided by the average dollar value of its assets under management. For JEPI, the expense ratio stands at 0.35%. In contrast, VOO has a much lower expense ratio of just 0.03%. This means that for every $10,000 you invest in JEPI, you'd be paying $35 per year, while with VOO, you'd only be paying $3. It's clear that VOO has a significant advantage when it comes to expense ratios. However, let's not forget about dividend yields. This is the financial ratio that shows how much a company returns to its shareholders in the form of dividends. It's calculated as a company's annual dividend per share divided by its price per share. When we look at the dividend yields, the tables turn. JEPI has a whopping 7.34% dividend yield, while VOO is at a mere 1.32%. That's a significant difference, and it means that if you invested $10,000 in JEPI, you could expect to receive $734 in dividends each year, compared to just $132 with VOO. In conclusion, while VOO may have lower expenses, JEPI compensates for its higher costs with a substantial dividend yield. This exemplifies the trade-off between costs and returns in investing, reminding us that it's essential to consider all aspects of an investment before making a decision. JEPI may have higher expenses, but it also provides a larger dividend yield than VOO. So which one is the better investment? Well, it's not a simple black and white answer. Both JEPI and VOO have their unique strengths and weaknesses. On one hand, VOO has shown a higher annualized return of 13.01% as compared to JEPI's 9.32%. However, it also comes with a higher standard deviation and maximum drawdown, indicating more risk. On the other hand, JEPI may not have the higher returns, but it does provide a higher dividend yield of 7.34% compared to VOO's 1.32%. Plus, it's less volatile, making it a potentially safer option for risk-averse investors. The two also differ in expense ratios, with VOO having a lower ratio of 0.03% compared to JEPI's 0.35%. Ultimately, the choice between JEPI and VOO is a personal one, depending on your own investment strategy and risk tolerance.